Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook for Friday, 28th of December 2012. We are back after the few days of Christmas holidays with our next session being on Monday, 31st, and then the next one will be on Friday already in the 2013. Situation in the market is as it is, no significant changes except dollar yen that is still top performer and hit levels last time seen from August 2012, 2010, being pressured, being supported well by a situation in Japan that pressurized by expectations, basically that the new Japanese government will push the Bank of Japan into more aggressive monetary easing as dollar rose against the Japanese currency and gained further momentum. With also stop loss, trading stop losses being triggered, which helped the dollar to hit levels at approximately 86.60 zone. That was the last time seen in August 2010. The Japanese yen also fell against the euro and touched its lowest levels in about 17 months. The euro soared to 114.67 yen. On its strongest level against the yen since July 2011. From the other currencies, the euro remains capped under 133. That proves to be quite a strong resistance, but recovered from the recent low posted on 21st of December at 131.57, with yesterday's extension as high as 132.82 being again hammered by comments from United States that is again being another pressuring moment for the single currency. However, a near-term structure is still holding a sort of positive tone, while the wider picture shows the pair in the sideways range, trading between approximately 131.60 and 133.00. And the question is now whether 133 will give way and extend the recent rally of single currency, or further and stronger correction below 131 will occur. From the other currencies, sterling against the US dollar remains under pressure, hitting fresh low at 160.65 yesterday, with the brief recovery so far being short-lived and more pressure seen down towards the downside. 160 is the level we are looking for in the near term. Dollar Swiss, similar to euro, remains entrenched between the 90.81 and approximately 91.80 zone. Sideways movements consolidating recent losses, but the near-term structure remains skewed towards the downside as pressure keeps the downside favored, and the possible break below 90.81 to open levels at 90.40 and then 90.00. Crude oil continues to trend higher, supported by current situation where it's still not clear whether the fiscal cliff will be triggered or not in the United States, as the recent high seen at 91.50. This is the overnight high with the scope for further extension higher. Gold recovered some of its recent losses as basic attempt is evident at 16.35, with the 16.66 seen so far, and where the pair found the so far resistance, and currently is trading in the sideways consolidative mode. More of all this we are going to have in our technical part. Just a few words I would like to say again about our top issue, and the top topic in the markets is, of course, United States and the fiscal cliff. President Barack Obama and the lawmakers are today launching the last chance round of budget talks, day before the New Year's deadline, to possibly reach a deal or watch the economy go off a fiscal cliff. As said, President Obama and Vice President Joe Biden will meet congressional leaders from both parties at the White House today at 20:00 GMT, so tonight. It's 3 o'clock Eastern time, to try to revive negotiations to avoid the tax hikes and the spending cuts, together worth 600 billion euros that will begin to take effect on January the 1st. members are divided on the odds of success, with a few expressing hope, some talking as if they had abandoned it, and small but growing numbers suggesting Congress might try to stretch the deadline into the first 2 days of January in order to be ready to legislate if an agreement takes shape. The Republican-dominated House of Representatives convened a session for Sunday, and the House Majority Leader Eric Cantor advised members to be prepared to meet through January the 2nd, the final day before the swearing in the new Congress elected on November 6th. If doesn't feel like anything that is very constructive is going to be happen as a result of a meeting with Obama, said Tennessee Republican Senator Bob Corker, it feels more like optics than anything that is real. Basically, we have quite still unclear situation with the two sides with the opposite positions, and we'll see. The next couple of days will give us a result and a clear picture of what's going on in the United States with the fiscal cliff. As we are still in the, I would say, holiday mood, a very tiny calendar is for today. We're going to take a look. Average cash earnings from Japan came already out at minus 1.1%. Positive release was seen in the previous one by minus 0.4 was the forecast. Chicago PMI, there is nothing from Europe except consumer spending from France due at 745, and then 1445 is Chicago PMI that's forecasted to tick higher to 51.2 compared to 50.4 of the previous release. Pending home sales from US is one of the key releases of 3 releases from today at 1500. The GMT 5.2 is the previous release, and pardon, minus 0.3%. We don't have it in our calendar. Is the forecast for today. And crude oil inventories as the last release today, as it has been postponed from yesterday to today at 1600 GMT. A draw of 1.6 million barrels is forecasted for today compared to a draw of 1 million barrels in the last week, and that's basically all from today's calendar. It's Friday. We're going to take a look now at the technicals and see the latest pardon, movements of the major currencies and commodities, starting with the single currency. Okay, you have the chart in front of you. 4-hour chart shows that structure is still positive, as most of indicators are holding above their midlines and pointing higher, as the pair finds ground at 131.57. This is the 21st of last Friday. Last Friday is basically low, supported by ascending 55 days exponential moving average, and finding support just above the 131.42. That was our initial support. 131.42.25, a 38.2% Fibonacci retracement of the upleg from 128.76 to 133.07, and the previous peak at 131.25, high of 5th of December, with the steady growing seen up to 132.82. This was yesterday's high, but again disappointing news from states pushed the currency lower down to 132, where the support was found. Overall, as said, still positive tone seen, but sideways movements are evident at this point, with the 133 being quite a strong resistance, and so far capping the upside. Of course, much now depends on the fundamentals and the final decision of United States leaders and officials, whether it's going to be falling over the fiscal cliff or some solution will be found. We believe that President Obama will finally reach the deal, as he said a month ago approximately, that probably they will find it at the last moment. The larger picture still keeps the positive tone, although some slightly extended conditions suggest that the 133 could be a top of the recent rally from mid-November's low at 126.60, while break above this level will open way higher, and look for test of 133.80, the peak of April 2012, and then we have strong barriers 130 at 135 zone. 134.90 is the 50% retracement of the larger 149.38 down to 126.60 descent, and also there we have the 200 days weekly 200 days moving average that currently stands at 135.00. As said, the near-term structure is still positive. Hourly indicators are in a way running out of steam, unable so far to regain 132.82, but 4-hour structure is still showing a more positive tone and sees possibility of further extension higher. Initial support 132.20, 132.30 and 132.00. Basically loss of 132 could shift risk again towards the downside. Interim support at 131.69 and the key supports 131.57, low of 21st of December, and of course Fibonacci support at 131.42. Conversely, break above 132.82 is to refocus and reattract 133 zone for a possible retest. The British pound lost ground after being rejected at strong 163 resistance zone, as we can see on the 4-hour ADX that bears still dominating, and especially on the daily chart where bulls lost traction, and now the potential is seen for a confirmation of double top at 163 zone, as repeated attempt failed again, and the pair is so far the pair has so far reached the low at 160.65. This was yesterday, pardon, approximately 76.4% retracement of the uplift from 160 to 163.05, keeping the downside pressure as 4-hour studies are negative and keeping the downside favored. Immediate dynamic resistance is at 161.38. 20 days exponential moving average, and the other one is 161.57 55 days one, while key barrier at the near term is approximately 162 double top, break above which is to refocus the upside barriers. Otherwise, a strong threat is seen for a retest of 160.00 zone. This is the low of 7th of December 2012, and also we have at this point 38.2% retracement of the larger down move. Just do apologize. Basically on the hourly chart we can see that the pair is in descending channeling lower, more focus again seen towards the downside with initial support at 161.00, the range, a level that has been regained overnight with 161.26 so far, but at the beginning of European session seems that bears again are taking control and again seeing more focus towards the downside. As said, 161 zone is quite a strong support, loss of which will again refocus 160.65 and the later stage 160.00 as initial target, while only break about 162 will provide relief. Dollar yen continues to trend higher as the best seen in the weekly chart, as the latest progress through some strong barriers, 84.17 yearly peak and the 85.51 peak of 2011 April, has so far reached 86.62, breaking above also important 200 days moving average at 85.00. The positive tone dominates despite some negative impact of the overextended 1 and 4-hour indicators that already triggered the reversal from yesterday's from overnight's peak at 86.62. That is quite expected following this recent strong rally. Immediate support is now coming under pressure, 86.00 zone, while the dynamic support is at 85.76 on the hourly chart, 55 days exponential moving average, and more significant, it's approximately 85.60, low of yesterday's intraday low, and the 38.2% retracement of the uplift from 83.84 to 86.62. Basically, any pullback is so far seen as corrective action and preceding a fresh rally. Important will be to see the weekly close above 200 days moving average, weekly 200 days moving average at 85.00. That will keep bullish structure fully in play for a possible extension higher, where we have 87.00 is around figure resistance, and the 87.56 61.8% retracement of the larger descent from 94.97 peak of 2010 down to 75.56. This is the low of 2011, posted on October 2011. Seen as the next upside. The targets with the corrective action expected to be contained somewhere at 85 zone, ideally, in order to keep the bullish structure in play for further extension higher, as the investors are expecting as we mentioned at the beginning, the more aggressive action from Bank of Japan. And finally, dollar Swiss, as we said, quite similar situation to euro dollar, but in inversed picture. After hitting fresh low at 90.81, the pair is consolidating rather sideways movements, with the upside being so far limited at 91.76 by descending 4-hour 55 days exponential moving average, and more focus is still seen towards the downside. 4-hour structure is still holding a negative tone, and sees again downside favored 91.00 and 90.81 are immediate downside targets, while while upside break above 91.75 and the more significant 92.00 level psychological barrier, and 38.2% retracement of the down leg from 93.81 down to 90.81 would provide temporary relief, and would allow for some a stronger recovery, where we will be looking for 92.30 and 92.40, which is the previous consolidation floor, and the 50% retracement, and then 92.66 as 61.8% Fibonacci retracement, and the 93 zone round figure resistance, and the 76.4% retracement, all require break above 92.00. Otherwise, more likely scenario is pardon, the daily structure also holds a negative tone, would be further extension, lower loss of 90.81 to target 90.41. This is the low from April 2012, and then 90.00 is around the figure support, with the weekly 90 days moving average currently at 90.76, so far holding the downside protected. Basically, on the weekly chart, the price is currently moving between 55 and 90 days moving average, but of course the near-term structure is aligned towards the downside, and still keeps bears in play, with the latest bounce higher seen rather like consolidation than any corrective action, with possible break above 92.00 to open way for some stronger correction. Otherwise, focus remains at the downside. And finally, we're going to take a look at commodities. Yellow metal remains under pressure, although some corrective action is seen now, as daily bears are now running out of steam, I would say, as corrective action of 1635, where the basing attempt is now evident, so far being capped at 1667. That marks approximately 38.2% retracement of the latest downleg from 1723 to 1635. Also, the descending 55 days exponential moving average limits the upside break here, and I would say more significant levels at approximately 1683, which are the previous lows, and approximately between 50 and 61.8% retracement of the latest downleg would provide relief and avert immediate downside risk. Although the larger picture is still holding a firm bearish tone, as the pair still struggles, the gold still struggles to regain 200 days moving average. Several attempts have so far not proper result. We are still at the dangerous zone, basically at the edge of further extension higher that will be seen on the lower top, and fresh weakness. Weekly close below 200 days moving average could be quite risky, as this will be signaling further extension towards the downside. On the downside, immediate supports 1652 1646 and the more significant 1635 and the 1628 that marks 100% Fibonacci expansion of the down leg from 1752 peak of 23rd of November 2012, and these are basically seen as our initial downside targets, while as we said, the break above approximately 1680, 1685 would provide a temporary relief, and the 1700 psychological resistance, previous high trendline resistance, and the 76.4% would confirm regain of this level would confirm the temporary base at 1635 and allow for some stronger recovery. Otherwise, any reversal under 1700 would risk a lower top and a fresh extension lower, with the levels, as we mentioned, 1635 and the 1628 seen in the near term focus. From the other side, the crude oil shows the signals of recovery as the price continues to surge higher, accelerating gains after leaving a higher low at 88.00 last Friday, with the latest high seen overnight at 91.48. On the daily picture, we can see that basically the price broke above the recent congestion peaks at 90.31 and 90.42 Fibonacci at 38.2 resistance. Also cleared the 90 days moving average, and now heading towards next barrier, which is 200 days moving average at currently at 91.78, and then we have 92.00 is around figure resistance, and then 92.38 50% retracement of the down leg from 172 to 84.05. Overall picture is positive, as we can see on the daily chart that all indicators are pointing higher. 4-hour indicators are quite extended at this point and suggest further corrective consolidative action. Basically, the pair hit 100% so far, 100% Fibonacci extension of the up leg of the wave from 85.20 low of 11th of December. And the next levels also to watch is at 93.85, 138.2% Fibonacci expansion. Corrective actions are not ruled out at this point, with the previous peaks at 90.52 and 90.31 acting as initial supports and seen as a good support for now, while any break below 88.00 would revive bears and put the upside, put the bulls, basically near-term bulls, on hold in favor of deeper reversal. At this point, let's just take a look on the smaller picture. The uplift from 85.20 to 91.48 faces, as we said, 90.52, 90.31 as initial support, and then 90.00 psychological and 23.6% retracement, reinforced by ascending 20 days exponential moving average. Basically, this is seen as ideal reversal point. However, a further extension lower cannot be ruled out. With the 90.89 zone, 89.30 is the 55 days exponential moving average, and 89 psychological support and 38.2% retracement seen as the next strong support. As we said, only break below 88.00 would again bring bears in play and sideline the bulls and keep the upside levels on hold. Otherwise, extension higher, and the targets, as we mentioned, 91.78 200 days moving average, and then 92.38 50% retracement are seen as a quite likely scenario, with the Fibonacci expansion 138.2% at 90.85 seen on a break. That was all from me. Please, if you have any questions, you can submit them now. I don't think there was no much action in the markets in the past couple of days. As I can see, when I came this morning, I realized that I didn't miss much except a bit of crude oil and the dollar yen. The rest of instruments are quite unchanged. No questions? Okay, then we'll conclude today's session. Thanks for being with us and attending our live sessions. We're back on Monday again, which is 31st of December, and then the next Friday is the next session. I think you have all received our holiday schedule for the daily market outlooks. I wish you a nice Friday, and of course very nice and relaxing weekend that will be used to prepare ourselves for celebration of the new year 2013. Nice Friday again, and good and successful trading, and we are back on Monday 31st of December 2012. Good luck.